Now that we've had a bird's eye view of the three key financial statements, let's dig a bit deeper into the balance sheet. Now, as the name suggests, the balance sheet must balance. And this is predicated on something we call the accounting equation, which is the foundation of all accounting. The accounting equation basically states this: assets must at all times equal the sum of the liabilities and shareholders' equity. To ensure financial statements are accurate, complete, and reliable, the accounting equation, I can't stress enough, must always be true. So let's dig into the accounting equation in a bit more detail and explore what we mean by assets, liabilities, and equity. So fundamental to understanding the financial statements is to understand how they interrelate as it relates to the accounting equation. Now, as we've learned already, companies have assets, and those are things they own. Now, assets can be things like inventory or equipment or property. Assets have something called future economic benefit, which means they have value that can be used to generate profit, or they can be sold off and liquidated to cash. Liabilities, recall, are what the company or business owes. Now, companies can owe amounts to vendors, suppliers, customers, and creditors like banks. Finally, equity is often referred to as shareholders' equity, and you can think of it as the residual value of the company. So imagine this: a company or business could liquidate all its assets and get cash, and then pay off all its liabilities, and the cash that's left would be with the equity. That's why we call it the residual value. Now let's look at owning a home to try and explain the accounting equation in a bit more detail. So let's imagine you have a home that's an asset that's valued at $1 million. But you also have an outstanding mortgage with a bank on your home for $750,000. So that's a liability. Your equity in your home would be the value of the home at $1 million, less the mortgage of $750,000, leaving you with equity of $250,000. In other words, if you sold your house and paid off the bank, you would be left with a residual value of $250,000. Now, over time, the equity of a business will increase through contributions to the business, maybe by issuing more shares or stock, and also by generating revenue and creating profit. Equity will decrease over time from things like increasing expenses or net losses, or through the payment of dividends to shareholders. No matter what happens, the accounting equation must always be true. The balance sheet must always balance. So I suspect by now you're probably asking the question, how do we make sure the balance sheet always balances? Well, in essence, we need to make sure that every single accounting transaction, when entered, is balancing the balance sheet. When the transactions are recorded in the financial records of a business, we use something called double entry accounting, or sometimes called double entry bookkeeping. Let's see how that works. As we know, assets are made up of things a company owns. That can range from the most liquid being cash to the least liquid being what we call fixed assets or capital assets. Capital assets include vehicles, equipment, building, and land. Now, capital assets or fixed assets are things the company uses to generate its returns. Capital assets are not the things that a business typically sells on a regular basis. If a company were in the business of selling vehicles, we'd actually call those vehicles inventory rather than capital assets. Now, the asset accounts are listed in order of liquidity. We start with cash, which is the most liquid, and move down to the least liquid. Generally, land and buildings are more difficult to liquidate than vehicles or inventory. Now let's look at the liabilities. Liabilities are listed in the order of the maturity. That is, when do they have to be paid back? Remember, liabilities are what a business or company owes. Now let's turn to the double entry bookkeeping. Asset accounts normally have what we call debit balances. DR is used as the shorthand for debit. This means that when recording transactions related to asset accounts, we debit the account to increase the balance, and we credit the account to decrease the balance. Now, CR is often used as the short form for credit. Now, in contrast, liability accounts normally have what we call credit balances. This means that when we increase a liability, we'll have a credit on the account, and if a liability is decreasing, we will debit it. Finally, we have equity accounts. Equity accounts are further broken down into revenue and share capital. Those accounts have normal credit balances. Equity accounts also include all expenses and dividend accounts. The increase in these accounts has a negative impact on the overall equity, so they have normal debit balances. The higher an expense account or the more dividend paid, the less equity remains in the company. Okay, now let's practice with our debits and credits. I have two practice exercises for you. I have one called Practice 1, which we'll do together right now, and then Practice 2, I'm going to encourage you do it first, and then when you're ready to debrief, click on the next lesson, and I'll debrief that practice exercise with you. Okay, so let's get started. You'll see at the top, I have put here a bit of a cheat sheet in terms of whether something is an asset, a liability, or equity, and what we do if we need to increase or decrease one of these. And so we have assets, of course, things we own, liabilities, things we owe, and then we have equity. And we call that equity has share capital or common shares, but it also includes our revenues and expenses. So the first question we always ask is it an asset, liability, or does it sit with an equity? So we have scenario 1 where we increase cash. Well, cash is an asset. It's something we own. And now that we know it's an asset, when we're increasing an asset, we know that the rule is it's a debit. Next, we have increasing a vehicle. Now, a vehicle is another thing a business or organization can own, so it's an asset. And again, we have increases to this asset, so it's a debit as well. Okay, let's go to the third one. Now we're increasing a loan. Now a loan is something we owe, so it's a liability. So let's just capture that it's a liability. And when we're increasing a liability, we credit the liability. When we increase share capital, we know that's part of equity. And when we increase share capital, we are also doing a credit. Now we have one more thing. When we increase an expense, recall that expenses are falling under equity as well. But when we increase an expense, unlike increasing revenue or increasing shares, it is a debit. Okay, so we've had a go together. Now turn to practice exercise 2. I'll just click on that now. Have a go through those 5 scenarios. And once you've had a go, then click on the next lesson and I'll debrief it with you. Bye for now. Well, now let's debrief practice exercise 2. Again, we have the cheat sheet at the top if you need it. And the first question always to ask is it an asset, a liability, or equity? And then we can think about whether we need to do a debit or a credit. So scenario 1 is we decrease cash. So what is cash? Well, we already know from the first practice exercise that's an asset. And when we decrease an asset, we credit it. Next, we decrease a loan. Now recall, a loan is something we owe. It's a liability. And we're decreasing a liability, so that is a debit. Now we go to increasing revenues. Recall that revenues falls under equity. And when we increase revenues, that is a credit. Number 4, the fourth scenario is we're decreasing equipment. Now, equipment is something a business can own, so it's an asset. but we are decreasing equipment, so that is going to be a credit. And finally, we're decreasing share capital. So for example, maybe an organization or company is buying back its shares. When we decrease share capital, we know that's part of equity, and we know, therefore, that is a debit. Congratulations, we've now had a bit of practice with debits and credits. Okay, now let's dig a bit deeper and record some actual company transactions using the double entry accounting system. So let's imagine that a business or company engages in the following transactions. First, the company wants to raise money to get their business going, so they issue shares for $100,000. In addition, the company takes out a 4-year loan for $50,000. This is just another way to bring money into the company and finance the company. Now, using that money, the company goes out and buys equipment and machinery for $80,000. The company also buys inventory for $6,000, but it then sells all the inventory for $10,000. Now, during the period, salaries of $1,000 are paid, and interest of $500 is also paid. So how would each of these transactions be recorded in the accounting records? Let's start by looking at what happens when a company issues shares for $100,000 in cash. First, the company's cash balance increases from 0 to $100,000. This is recorded as a current asset on the left side of the balance sheet. Now, to ensure that we are constantly balancing, we would have to record a transaction on the right side of the balance sheet as a liability or equity. Alternatively, we would have to record a negative number on the asset side of the balance sheet. In this instance, we record $100,000 next to common shares under equity. The balance sheet balances assets equal total liabilities and equity. Now let's look at the same transaction from a debit and credit perspective. Remember that increasing assets is a debit. Since we added $100,000 in cash, which is an asset, we debit cash. The increase in equity, you may recall, is recorded as a credit. The key thing here is that our total debits have to match our total credits. That's the accounting equation, that assets minus liabilities and equity still actually holds. In this case, we have $100,000 equaling $100,000. Now let's look at a second transaction. Let's see what happens when the company takes out a 4-year bank loan of $50,000. We saw that a company can raise money by issuing shares, but companies can also borrow money from financial institutions. In this instance, the company is taking out a 4-year bank loan of $50,000, so our cash will go up by $50,000. Recall, cash is an asset, and because it's increasing, we're going to debit cash $50,000. We also, though, now have an obligation to pay the bank in 4 years $50,000. So we have something we owe, and that's a liability. And when we increase liabilities, we credit them. So we are going to debit cash $50,000, and we're going to credit loan payable $50,000. Again, the total amount of debits and credits cancels each other out, and the balance sheet continues to balance. Before going to the next transaction, one thing I want to draw your attention to is the identification of accounts that are either current or non-current. I mentioned before that assets are listed typically in order of liquidity. Current assets are those that can be liquidated quickly and used by the company in the short term. Companies expect to use these assets within their current accounting cycle, or typically 12 months. I also mentioned earlier that liabilities are ordered by their maturity or due dates. Current liabilities are those obligations that a company must meet within the short term. Again, that is usually during the current accounting cycle, which is typically 12 months. Because this is a 4-year loan, it's considered a non-current liability. So now let's move to our third transaction. Let's see what happens when the company uses its own resources to buy $80,000 of equipment. So here's an example of one of those transactions that impacts only the left side of the balance sheet. Remember, as long as the total debits equals the total credits, the balance sheet will continue to balance. In this case, the company is using $80,000 of cash to purchase equipment. You can think of it as swapping one asset for another. The company gave up cash to gain equipment. Now equipment is an asset, and we're increasing equipment, so we debit the equipment account. Cash, we know, is also an asset, but in this case, we're decreasing an asset, so we credit cash. The next thing the company needs to do is buy $6,000 of inventory, which it intends to sell. Again, we are swapping one asset for another asset. Inventory is a current asset that is increased, so we're going to debit that, and cash has decreased by $6,000, so we're going to credit that. You can see that the balance sheet still balances, and total debits equals total credits. So far, we've seen what happens when we make adjustments related directly to the main balance sheet sections. So we've seen the company, for example, add equity and liabilities, and we've seen several adjustments to our current and non-current assets. Now, although we would normally record transactions related to income and expenses on the income statement, it's critically important that you understand how that impacts the balance sheet. Previously, we discussed the different types of accounts and their normal balances. When we got to the equity section, you might recall we had a few different accounts that had different balances. Overall, equity should be in a credit balance. It resides on the right side with liabilities, which also typically have credit balances. However, equity is made up of a number of different accounts related to revenue generation and common stock. Now, if you recall, I mentioned that revenue and shareholder contributions, also known as common stock or common shares, have credit balances. They increase equity. So, for example, as the company generates more revenue, the value or equity of the company goes up. Conversely, expenses and dividend payments bring the value of the company down. The more expenses the company incurs, the lower the equity. Okay, let's move to the next transaction where we see the company sell all the inventory for $10,000. So far, our debits and credits have been just one debit with a matching credit. In this instance, we're going to have two debits and two credits. So it's a bit more complicated, but don't worry, I've got your back. So I typically like to start with cash. What's happening with cash? Well, cash is increasing by $10,000. So increasing an asset is debit. So we debit cash $10,000. But we also have generated revenue for our business. We call that revenue is under equity, and when we increase revenue, it's increasing equity, and so it's credit revenue $10,000. So far, so good, our balance sheet balances. But we also have to deal with the inventory. We no longer own inventory as we sold it all. So we decrease an asset, which is a credit. So we credit inventory $6,000, but we then need to debit something else. Now, inventory expense is referred to as cost of goods sold. And we know that expenses sit under equity, and that if we increase an expense, it's a debit. So the second part of this transaction is debit cost of goods sold, which is an expense, $6,000, and credit inventory, $6,000. The good news is our balance sheet continues to balance. Okay, here's our next transaction. Now we want to record the company's $1,000 in salaries. Part of the day-to-day operations of all companies involves incurring operating expenses. Companies hire people to perform certain tasks and in return pay them a salary. In this case, the salaries paid amount to $1,000. So we're paying them with cash, so we're decreasing an asset, so that would be credit cash. And we also need to increase an expense, and we know that's a debit that sits under equity. So we have debit salary expense of $1,000 and credit cash $1,000. Keep in mind we're still using the double entry bookkeeping system, and our accounting equation remains true. Assets of $153,000 are equal to liabilities of $50,000 and shareholders' equity of $103,000. Okay, we're almost there. There's just one more transaction. We need to record $500 of interest that the company needs to pay for its bank loan. Banks obviously don't provide funding without a cost. Instead, they charge interest typically based on the outstanding loan balance. In this case, we're going to assume that the company needs to pay interest immediately at $500 on the loan balance. So what do we see? First of all, we have to pay it out of cash, so we decrease an asset. And when we decrease an asset, we say we're crediting it. We credit $500, but we also now have an interest expense. And that interest expense sits under shareholders' equity. And remember, interest expenses are debits. So we debit our interest expense $500 and we credit our cash $500. And good news, the balance sheet continues to balance. The accounting equation holds.